Hi everyone, and welcome to another episode of the HeelanHub podcast, the show for small business owners. I'm Dan Heelan. On today's show, I want to talk to you about holding companies. Now, whether you're just starting out or you're experienced, I think this is a good thing to understand, particularly in an age where we've got, your TikToks and your Instagram reels and all the rest of it. I found there's more and more conversations happening around this topic where we're seeing maybe half of a story presented. So I thought it's a good opportunity really to go into it and just talk about actually what are the kind of pros and cons of this. And I suppose the biggest mistakes as well that we see being made around this topic. So this one's going to be a good one. So let's get on with it. So if you're thinking about making a holding company because you've seen that it's a really good idea, I think this is going to be a really interesting episode for you because I'm going to recap effectively like where we are, what a holding company is, why it's not a tax miracle. And I think that where I want to show you is actually can cost you money. Now, particularly if you're watching videos that maybe go back a few years ago, or you're seeing reels or information online talking about this, probably 4 or 5 years ago. A lot's changed in tax since. That actually means they're probably out of date anyway, but I've seen some modern content talking about this idea that it's a miracle tax solution. So we're absolutely going to debunk those kind of myths. And as always with these podcasts, at the moment, at the time recording this podcast, we're currently playing around with lobbing them on YouTube. Whether that continues is to TBC, I guess, but at the moment we're throwing up there so that hopefully if you have any comments or questions on these episodes, you can actually go there and drop into the comments. So it's cool. I think one of the downsides of doing a podcast on audio is that you don't get to interact like we do on our main YouTube channel over at Heelan Associates. So do check it out, and we're testing this experiment. We'll keep going for most of the year. So that's that. So that out the side, let's talk then about a quick recap about what holding companies actually are. And for me, a holding company, they get over kind of complicated, I guess, because in reality, all they are is another limited company. They're like any other limited company. Depending what you do with them, there are some sort of tax status things that can occur. So you can get to a point where certain reliefs aren't available, or it pays, the higher rate of corporation tax because it meets certain criteria. There's things like this that can affect it. But ultimately, in every kind of operational point, it's just another company. The reason they call it holding is quite often, if you think of a limited company structure, it's quite often put in at the top. So it's hard to describe on a podcast, but if you imagine that you've got a flat structure, you've got your business at the bottom, you might insert this holding company at the top. And all this holding company does is it owns the bottom company in its entirety. And that's kind of the normal way you see these things set up. So yeah, this holding company owns the trading company 100%. The trading company in this is your current business. If say you've got a limited company, or the limited company you're thinking of setting up, which actually does all the work, trading company is often what it's referred to. So you've got these things going on. And that's all it is, really. And normally the reason you use it is because you want to ring fence some sort of money. So let's say your trading company does really, really well. It's got a load of money in it, and you want to make sure that money's secure so that if anything happens, I don't know, you get sued or bad times happen later and you got this amount of money you don't want to lose, you can pay it up in a dividend in profits up via its shareholding to this new holding company. And it's ring fenced. If anything happens to the one below, and in general circumstances, there's going to be no problem. That'll disappear and your holding company will continue on with its own money. And quite often it's like a vehicle then that people use for investment. So if they want to get into properties, which is something that quite a lot of owners aspire to, then the money goes up, it's safe, and then it will then use that money in the holding company to go and invest in property. And that holding company might end up just running a property business, or it might invest money or do something else. So that's generally what you see it for. And I'd say the most scenarios where we see it is exactly that. They just want to ring fence the money and just make sure that like legally we're a bit more protected. And that's normally where it's done. I'd say that the actual reasons to do it for tax, I don't think I've ever done one for a tax saving and this is going on 18 odd years of doing this. I don't think we've ever done it for a tax saving reason, which is why I think it's always interesting when I see these videos talking about this kind of thing. It's normally for risk or for just organizational purposes. For example, you might decide you want to have several companies. So you've got this holding company, and again, I know this is on a podcast, but you've got a holding company at the top, and then underneath you've got your current business. You might add another business just to the left of it. So imagine your trading company's at the bottom right, bottom left, you might add another one. So the holding company also owns that. If you then decide to sell your existing business because it's done really well, you can do that and kind of just sell that branch of the group structure off to one side. So there's a lot of like structural reasons why you'd want it done, and we do that a lot. Or like, let's say you're in property development, we work with quite a few property developers where this is the case. You'll have different property developments under different, they're quite often, you might hear this term SPV. Again, it's just another limited company, a special purpose vehicle, and they'll do it because again, risk-wise, we're building a property and keeping all the risk here on this property. So another property and another company to the left, if you like, is not going to be, if it's all done correctly, not going to be at risk if this one on the right fails. So those kind of things structurally, that's what they're for. Now, That's I suppose, the recap of what the actual holding company is. But what I would say is that often it's not an expense that you need if you're starting. If this is you now and you've heard that, I should start with these things, it's normally people who are promoting this have a vested interest in promoting it. And that includes accountants, by the way. I mean, obviously, it's another limited company. It's more limited company fees. So you will hear people going, oh, yeah, it's absolutely a good idea. And they're not wrong in actually concept, because that is a good idea. But just know it's possible. There's a bit more tax work to do around to do it. But this is, I'm trying to think, probably a handful of times have we ever had a structure where we've had a limited company at the beginning. Like it's very rare scenario. Normally in property world, in the property world, you would do this quite frequently, but in like a normal trading business, it isn't very often someone comes to us and we say, you definitely need to get yourself a holding company from day one, because it just adds cost. And also there's a lot of practical admin around it. So for example, you have to be very strict with yourself about whose money it is that you're spending. And people tend to end up using it a bit like a slush fund, and the money moves around in a bad way. So you'll have, I don't know, the trading company will start paying for the holding company's bills, or the holding company's got the cash in that bank account, so you start paying for the trading company's bills, and you end up on paper with what's known as an intercompany loan account, which actually defeats the entire point of this entire scenario where you're trying to ring fence debt, because now suddenly one of the companies owns the other company money. Hard to describe in a podcast, but let's just say it very frequently happens, and particularly with inexperienced owners. Not always. I've got plenty of experienced owners that do this as well. So having it early means that it's just going to cost you a lot of money, but know that you can insert it later. And as I said, there is some tax work that goes around that, where you've got to normally get clearance, because the normal way you would do it requires a bit of tax clearance, but it's not that complicated. And nearly every time we've done it, that's been the case, where you add it later, you sort of insert it and swap some shares around. So it's all possible. Now, I did say to you that, look, it could, forgetting money, it can cost you in tax. So I've seen this idea where you see these on Reels where someone will say, look, here's how a holding company saves you tax. I've had so many clients ask us this in the last year. It's on the rise. And they'll show a scenario where they're like, here we go, and they draw it out and they'll say, we insert a holding company, and this holding company is going to charge management charges, or it's going to license something back to the trading company, or whatever. For whatever reason, it's going to charge something to the trading company, to your current business, and reduce its profits, or with the goal of wiping its profits out. Now, forgetting for a minute whether that's actually possible and whether it would stand up in terms of being wholly exclusively for business and all these things, because I think people just presume you can make this stuff up. They would need to be legitimate, but it absolutely does happen. There is company structures where this occurs, but so they're showing this half of it, and they're saying, so you do this, and then your profit could be zero, and therefore you've got zero corporation tax to pay, and you've got no profits, paid no tax. How amazing is that? And that's the video. And so, yeah, it's great. But now let's do part 2 of the video and say, well, what happens at the holding company end? It's now got a trading activity. It's now charging for management, or it's licensing something, or whatever the case may be. It's now received that money. It's now got profits. It's now got a tax bill. And that's the first kind of myth, I suppose, to debunk there, is that there's still a tax bill. You just moved it from one to the other. Now, sometimes, depending, and this is a bit technical, depending on where those limited company year ends are, said that really weird, where those limited company year ends are, you might have a point where actually you're delaying tax slightly by doing this, but it's a very small cash flow benefit, in all honesty, and you have to be very careful with how you're actually doing these cross charges. But so yes, there is some small benefit there on an odd occasion, but it normally doesn't play out like that. But the actual idea that this just eliminates tax is a complete fallacy. It doesn't. You've just moved it into another company. And then the instant thing people then say, because I've talked about this, as you would imagine, on social media, someone will say, yeah, but I'm going to go and stick it all into property, so it's going to wipe out the profits. That's not how property businesses work. That initial purchase of that property is not going to suddenly wipe out your the money you've moved up. The money that comes in is going to be taxed. The weird thing is, if you paid it up in dividends, it wouldn't be taxed. So there's two different things going on here. I don't want to confuse the two. If you paid money up in dividends, if you imagine the way dividends work is in your trading company, you've been taxed in the trading company, so they don't tax you again when you pay dividends up to the holding company. What we're talking about here is a scenario where you're charging management charges or something like that to reduce the profit in the trading company. When that money comes up, that's taxable kind of trading income, and you buying the property is not going to wipe that entire bill out. It's just not the way it works. And then, of course, forgetting the fact that you've got income on any rental income that comes in. And then people say next, They go next down the list. Okay, yeah, but I'm going to take a mortgage and my mortgage repayments are going to be more than the profit. Well, there's a couple of things there. One, in a practical scenario, that almost never plays out because of timing. It just doesn't. You've got all this money coming in one payment and then your mortgage payments are over a period of time. So the timing doesn't often work. And then on top of that, you've got this fact that a lot of the time, if people do repayment mortgages, not all of that interest is going to be tax deductible anyway. So just trust me, on a podcast, it's hard to do. And I'm also conscious of saying, trust me, as I've just told you, that a lot of people online aren't giving you the full story here. But I'm just telling you real lived experience doing this for however many years in lots of different scenarios. That just doesn't happen. So yes, there sometimes can be benefits to having a holding company, but tax saving really isn't one of the key ones. But it can do it in places, or at least reduce it, just because of where you might have expenditure. But honestly, if I was starting a business particularly, or in my early stages, it wouldn't be the first thing on my list to do. I'd be looking at it when I had, some decent cash reserves I wanted to do something with, or I was starting a new venture, or I was looking to sell things. Like, there's a lot of reasons why you might do it, but have a look. Now, the other hidden cost, and this is a big one, this is a really big one, and this is where I said to you about the fact that some things changed about 4 or 5 years ago. It all blurs into one in tax. It could be longer, it could be shorter, but let's just say in my head it's about 4 or 5 years ago. Don't worry about fact checking; it's irrelevant. The point is, something changed, and that was the way that the company tax rates worked. And there's a thing called associated companies in the game of accounting. Quite often, people just say, "Oh, the associated company rules." But what it means is that when you have this group. And it's a very complicated subject, actually, but let's just keep it easy. You own this holding company 100%, it's just you, and that holding company 100% owns the trading company now. So you've inserted this extra company. They're going to be what's known as associated. And if that limited company holding company does anything other than just receive dividends and pass it straight out, they're going to be associated. There's like this exemption for what's known as a passive holding company, but it's so strict that if you're doing those management charge things, it's not going to count. So again, people rely on this thing. They go, oh, it's just a holding company, it doesn't count. It absolutely does count unless it's a passive holding company. And the passive is very defined in law as to what that is. So in this example where we've got this miracle scenario, a little bunny is that's happening, you're trading. So you've got this problem that it is associated. And what happens with associated companies is, at the moment, quick recap on corporation tax, the first £250,000 of profits, if you don't exceed £250,000 worth of profits, is taxed at below 25%. So the way it kind of works is you've got this £50,000 at 19%. And then for mathematical reasons, this other bit's taxed a lot higher. But I want you to focus on the 50,000 at 19% for now, just to keep this scenario easy. As long as your profits are under 250, there's a chunk of money there that in theory is charged at 19% tax. Now, when you have an associated company, all those numbers I just mentioned are slashed in half. You keep slashing them for all the amount of associated companies you've got. So you've just added one, so slash it in half. So your £250,000 profit before you start paying the main corporation tax at 25% has now gone to £125,000, and that £50,000 at 19% is now £25,000. So if your holding company is not doing a lot, but it is doing something, and your trading company is making more than £25,000, it's actually going to cost you tax, because previously, let's say it made £30,000 profit, that would have all been at 19%. Because you've now added an associated company in there, now there's at least £5,000 of it that's going to be taxed at more money than the 19%, because your limit's now 25%. I hope I've talked quite quickly there with a lot of numbers, but hopefully that plans out in your head. You're just slashing all the limits by every associated company. So it can actually increase your tax bill if you get it wrong. So it's absolutely worth thinking about whether it's a good idea. So there we are. Now, as I said, I think a couple of myths there then. So management charge fable, as I like to call it, this idea you absolutely can charge management charges if you structure it correctly and everything else, but you're just maneuvering where the tax is paid and where the income's coming. You're still going to be paying tax somewhere. And as I say, even if you do it properly, the numbers usually won't wipe it out. So I think what you really need to think about doing is just hold off, as we say, take a breath, get some professional advice on whether it's right for you if you need that. And before you insert it, don't just instantly think, yeah, I'm missing out. Because we talk to clients a lot about this. I think there's that FOMO, that idea that, there's this fear that you're missing out on something because you've seen it online a lot. And in most cases we look at, they're not missing out at all. You explain actually, well, what is this going to achieve? And we talk through the scenarios and draw a lot of pictures, and they're like, yeah, it doesn't make any sense, does it? We're like, no, otherwise we would have told you about it. So just, think about those things, and hopefully you'll come out of this episode a bit more up with actually holding companies. Are they worth it or not for you? So there we go. Hopefully you've found this episode of value. And if you have, please do share it with anybody that you need to know. If you don't mind subscribing via your favorite app, that means you won't miss an episode. And if you get a chance, I know loads of you have done it, please just drop us a review on there if you enjoy it, or some comments if the app allows you to do that. It's really cool to read and helps our visibility. So thanks very much. For more business insight and tax tips, be sure to connect with me and my great team, and of course, all the social media channels like YouTube at Heelan Associates and the HeelanHub channel itself. You've got TikTok, Instagram, LinkedIn, Facebook, Twitter, anywhere there's a social media app, pretty much we're there, not Snapchat. But follow us on there, and hopefully you can get some more tips and insight there. You can also, if you like emails and like to read, we've got a newsletter you can sign up to. The HeelanHub Herald comes to your inbox every 2 weeks. If you go to the website at HeelanAssociates.co.uk and scroll around long enough, you'll be able to pop in your email there and sign up. I did see somebody the other day just email us and asked to be added to the email list. You can also do that, or email us about anything at the podcast. You can do that at info@HeelanAssociates.co.uk. And finally, if you're thinking of getting into accounting software, for us, there's only one winner, albeit there's some really good ones. We use multiple here inside of our business with our clients, but Xero is the clear winner for us. And given that if you're a sole trader and you're needing to deal with making tax digital, which we spoke about in a previous episode, or you're just starting a business and you need to get yourself in cloud software, if you're a limited company, you absolutely, from my personal opinion, you're doing yourself a disservice if you're not into some software. You can get a ridiculous discount at the time of recording this podcast at HeelanAssociates.co.uk/Xero, and it'll take you through there for a really cool reduction in Xero license as a new customer. So go do that. Obviously, we get a bit of a kickback. You get a win. Everybody is a winner in that. And that's it. Have a profitable and tax efficient couple of weeks, and I'll see you the next one.